everyone. It's PJ Patterson here. It's Friday, the 21st of June. I hope you all had a great week. If you've been watching the price of gold, you certainly have. Today's top three things are going to be, starting off in that order, gold, a discussion about interest rates both in the U.S., globally, and in Australia. Finally, some economic data, and then I'm going to point out something or share with you something that I had a conversation with a credit assessor with today. First things first, on your screen you can see the US dollar gold price. It is now getting very close to the $1,400 range. It's accelerated well above the $1,350 range, which was, for a lot of technicians out there, was a key resistance level. Had a big jump overnight, and that is off the back of the fact that all of the central banks are exceptionally dovish at the moment. Australia is no different. If you just hone in on this line here, you can see that the gold price yesterday, in actual fact, it bumped above $2,000 an ounce, and it has rocketed from there up to almost $2,030 an ounce. It spent the last couple of months sort of in that 1,800 to 1,850 an ounce range in AUD, or Australian dollars, and it's really accelerated now and will probably continue to be reasonably strong because of what's going on in the interest rate market. I'm just going to drop over to another screen. So obviously the media's picked up on this now. You can see it's well above $2,000 Aussie an ounce. I haven't really read this article. I'm not sure what else they have to say here, but the reality is the gold miners are going to be getting a really strong bid, and that's exactly what has occurred over the last few days. The gold miners have performed very, very well, and those of you who have a lot of that in your portfolios, which is many of you, you would probably want to go take a look and see where you're at and the nice gains that we've clocked in the last couple of days. Now, I'm just going to turn to a discussion about interest rates, because gold and interest rates are very interrelated, and the relationship is this: gold goes up and likes an environment where interest rates are falling, and so and or inflation is rising. We don't really have the inflation piece kicking in at this stage, but we certainly have the interest rates falling piece. And we have the dovish central banks. So that's what that's what gold really likes. And there was an article a few days back where CBA has come out and said that they reckon rates are going to hit 0.75% within months. I don't know how long months are, but certainly we are going to continue to see our central bank here in Australia likely dropping rates. And that, in large part, I believe, is going to be due to the fact that our economy isn't doing great, and the housing market in particular isn't doing so well. So what we're going to be seeing, and I know I started really with the Australian interest rate picture. I'll jump over to the U.S. in a moment. But what we're going to be seeing from our central bank, I suspect, is very dovish language, and they're going to want to really start to see data with regards to wage inflation or wage growth improving. You're going to want to see, I suspect, the housing market stabilizing and maybe moving up from here. For any of you watching this who are thinking about buying a house, now's probably not a bad time to dip that toe in the water and see, if you can get some good deals, because with interest rates continuing to drop, that is going to definitely get the punters out there re-interested in borrowing money and in moving forward with that. Now, unfortunately, I had some camera problems and some other issues, and I've had to record this a couple of times. I did have an article about bank lending, and I'll just paraphrase from it in a moment. But just to keep on the theme of interest rates again, RBA's out there banging the drum, saying further rate cuts are imminent. So they're signaling that, right, with their language. So one of the articles that I've looked at in the last few days from CNBC is that the U.S. Fed, when they had their interest rate decision this week on Thursday our time, the language they used about interest rates was that they were going to be patient. Now, what was interesting in the lead up to that meeting is that Donald Trump, and I'm just moving now to U.S. interest rate discussion, Donald Trump has been trying to jawbone the Fed chair, Jerome Powell, to lowering interest rates. And this is very risky because the Fed chair is not politically motivated. He does not answer to the President of the United States. although he does appreciate, or he or she, if it's a female sitting in the chair, as we had in the U.S.'s previous Fed chair in Janet Yellen. Uh, they do things not politically motivated, but they do have to consider political motivations, if that makes sense. And the data just doesn't support the U.S. Fed cutting rates. And what I mean by that is, if you think back to December of last year, 2018, the Fed had been signaling for a while, the U.S. Fed, that they were going to raise interest rates. And they started to do that in October, I think it was, September, October of last year. And the market didn't like it. And the stock market effectively crashed in December. And so what happened? The U.S. Fed said, we're going to reverse policy and we're going to stop that, and we're probably going to now do some rate cuts. So they pretty much reversed course, and they rescued the stock market. And the stock market has been going up since then. And the stock market actually in the U.S. has hit an all-time high. The S&P 500 did overnight. And the Fed is just simply not going to cut rates into a rising stock market. It's just not going to happen. So what's interesting about all of this dynamic going on is obviously Trump wants to get reelected. He wants a strong economy. He wants the U.S. dollar to be devalued as well because he wants U.S. corporations to be more profitable and to be able to export. And so this is all part of this currency war stuff that's going on, the trade war stuff that's going on, is the U.S. dollar needs to be weakened against a number of currencies. The problem with the U.S. dollar, of course, is that it's the world reserve currency, and so a lot of people obviously use U.S. dollars for trade and so forth. So by virtue of that status, it's going to have a certain strength to it. But it'll just be very interesting to see going forward how the U.S. Fed treats interest rate policy if we get a sell-off in U.S. equities. And again, apologies, I don't have this information up here, but one of the things I've been talking about over the last couple of updates is us being in an earnings recession, and that we have had the peak of the economic cycle probably about 6 to 8 months ago, and we are now in the down slope of the economic cycle. Now, what that's going to do effectively is it's going to mean that the comparisons between earnings of, say, June of this year versus June of last year for corporations these comparisons are going to be bad. We're going to see earnings having slowed, and we were going to see companies revising their guidance downwards because we're in an economic down cycle. And the only evidence I really need to give you that is occurring, other than stuff I've already mentioned, which we do know that earnings are slowing, is this interest rate policy. Why would the U.S. Fed, why would the Australian Reserve Bank be cutting rates if the economy was strong and everything was hunky-dory? They wouldn't be doing it. They'd be raising rates. So, ladies and gentlemen, I continue to maintain to you that interest rates are being cut because the economy is doing poorly. Really no other reason for it. I think they're being cut in Australia also because housing has not been doing well. And let's face it, a lot of people have a lot of wealth tied up in property. It's a very popular topic. A lot of Australians love housing, and it's probably where most of our wealth actually is kept, is in the housing market. So when housing is not doing well, the mood of the consumer is negative because they don't feel as wealthy. They're not going to go to the bank and borrow money to buy another property or to do renovations or whatever. And this is something that we have seen. Again, I don't have the slide up. I had the article up, but my computer did something funny. But some numbers have just recently come out from Australian Deposit Taking Institutions, ADIs for short, that lending has dropped by about $15 billion in the last quarter. This is a huge number that it has dropped. And look, the long and short of it is that, and I've said this many times over the years and written and recorded updates, that if you do not have credit expansion, if you do not have lending growing, you will not have asset price inflation. And lo and behold, what have we had over the last 12 months or so, or 18 months? A decline in housing. It's down 15% or so in Sydney, equally in Melbourne. Other parts of the nation down, varying degrees, between 0 and 15%. I think the only place where housing was actually doing well was in Hobart, of all places. Nevertheless, my point is simply that without lending growth, we're not going to see house price growth. And so here we have the Federal Reserve in Australia, the RBA, cutting rates. So now is probably that period of time where we're getting close to the bottom in this cycle of the housing market. Are we there yet? I don't know. But what I can say is with interest rates being cut, certainly we're going to start to see something happening in the housing market. Now, I want to turn to economic data and what's going on with economic data. As you all know, I'm relying very heavily now on a data-dependent process to tell me where to invest money and where to allocate assets. And so those of you who listen to me on a regular basis know I've been talking about the rate of change of data, and that a lot of the economic data that's coming out month after month is very bad. And so if you look at, for example, this data out of Singapore here is just horrendous. And these are some pretty critical numbers here. So Singapore, big exporting country. They are a bellwether when it comes to that. We have non-oil domestic exports down 15, or almost, might as well call it 16%, and electronic exports down over 30%. These are horrendous numbers and not a good sign, given that Singapore is such a mecca for export. A lot of goods flow through Singapore. So for that to be down, that is not a good sign of what's going on in the global trade environment. So, again, I reiterate this call that the global economy is slowing. If you look at some of the data that's coming out of Europe, same sort of thing. A lot of the UK numbers are bad. Other parts of the Eurozone numbers are bad. Basically all this red stuff that you see on these economic charts, economic data points, are bad. So it's no wonder we have the European Central Bank saying they're going to do whatever it takes now to stimulate their economies. And I just have to say, ladies and gentlemen, I've said this before. The last 10 and actually 12 years now, we have had quantitative easing. We've had negative interest rate policy in some parts of the world. We've had all sorts of money printing and other low interest rate policies being put out there. And here we are, still little to no economic growth. And I've talked about the GDP deflator, I think, in my last update. When you factor in inflation, which you have to deflate the GDP number by inflation. So if you have a 3% GDP, but inflation is 2%, well, really all you've done is grown GDP by 1%, which is pretty crap, if you ask me. So, a good net GDP growth rate would be 3 to 4%. That's when you're really humming and, the economies are growing and wealth is growing and all that sort of stuff. But the reality is we just don't have that. We may be even in negative GDP in some parts of the world because of that deflator aspect. But just to lock off the economic data discussion, absolutely we are in bad shape right now, and it's getting worse. And we're just in a period right now, again, where the data is suggesting that we're going to get more quantitative easing. Let's call it cowbell, more cowbell. And that's going to continue to put a bid under certain types of asset classes, in particular, the precious metals. So I do expect there to continue to be a firm bid in precious metals and gold in particular, and that will obviously benefit a lot of my client portfolios that are set up that way. I still want to stay quite heavily focused in the fixed income space because we just want to keep getting paid by fixed income with little to no volatility to our capital, and then I generate that alpha through having the exposure to some of the right asset classes, which of course, as I just said, will be gold and precious metals. Now, turning to something that I thought was quite interesting, I had a chat today with a credit assessor. Got an approval for a client who's looking to buy a property, and we were chatting about the approval. And one of the stipulations on the approval was that they couldn't, if they were going to buy a unit, the unit couldn't be in a high-rise apartment building. And their classification of high-rise is anything over 6 stories. So this was interesting, and I started chatting with them about it, and it dawned on me that we've never had an issue of construction risk or any of that sort of risk in these apartment blocks. And let me just expand on that for a second. Think about this, right? If you're a bank and you're lending billions and billions of dollars every quarter out to the housing market, the last thing on your mind really is to think about, is that building going to fall down, right? And for those of you that have been paying attention to what's going on in the media, what's going on in this space, there's a few tower buildings in Sydney that have had massive problems. They have had cracks. They've had other issues, and some of these buildings are brand new. Others aren't so new, but a couple of them were just recently built. And it raises this idea now, and I suspect bank risk departments, I have no proof of this, but I suspect bank risk departments are now asking the question, how do we mitigate the risk of a building not being constructed properly? And what are those risks? And if you think about it this way, there's a lot of high-rise going up, particularly in Sydney, and the banks now might have to adjust their policy when they lend to these high-rise developments to adjust for construction risk. And will that security be devalued by 20, 30, 40, 50% because of shoddy building practices? The answer to the question is, I don't know. But what it does suggest to me is it's probably a good idea to stay away from high rise. If you're thinking about buying an investment property, stay away from high rise. Buy house and land, buy townhouses, buy stuff that's in a block that's 6 stories or less. Doesn't mean that block that's only 5 stories high is at less risk of having construction issues. But I dare say if it's only 5 stories or 4 stories, the cost to fix something like that will probably be far, far less than if it's a 30-story or 25-story building. But anyway, just something to think about, something quite interesting. As always, please do leave comments and questions in the comment section or in the boardroom. Always happy to answer questions. But just to lock things off for this week, it's been a big week for the precious metals. Interest rate policy continues to be dovish, so we're going to continue to see fixed income performing well and the metals performing well. And interest rate policy isn't going to change anytime soon, so continuing to be dovish. And economic data continues to deteriorate. So whilst we're seeing a bit of a blow-off up to the upside in the equity markets, I do think that we should fade this rally and not buy into it, not chase it, and certainly and I'll be speaking to individual clients about this, but looking at this as an opportunity to take some profits, take some money off the table, and reload the cash reserves for potential buying opportunities. I will look forward to our next update, and I wish you all a happy weekend. Cheers.